actually decided to like pivot a little bit. So we were up for the first couple of years of us investing in self-storage. We just found private lenders, and we would just work with private lenders to buy property. We would just take the debt, and we would go out, like essentially somebody would come to me and say, hey, like I have like 400 grand or 500 grand or whatever they would have, can you do anything with this money? And I say, yeah, of course I can. And I would just go out and I would buy a storage facility. And so we typically focus on smaller facilities. From $1 million down is what we focused on over the last 5 years, because I just talked to people just like you, and and then I just asked, I asked them if they have any money. They lend me the money, and I would just have, I'd have a loan on the property, and I would pay back the person that lent me the money, right? So what happened is, over the course of the last 5 years that I've been investing in self-storage, there's basically like 3 different types of investors in this industry. Okay, there's like the people that are the newbies that are like, I want to get into self-storage. I want to own a storage facility. I've been thinking about this for a long time. I own a piece of property and I want to go build a storage facility, right? That's the type of person that I coach. Those are the people that like, they want to get into the industry, but they don't really have a lot of money to get into the industry. And they focus on typically $1 million or less storage facilities. And these usually fall into tertiary market areas of your state, sometimes secondary market, but mostly tertiary markets, which tertiary just means the country. Okay, and that's what I did. I focused on tertiary markets. And then you have on the other side of the spectrum, you have the people that are like, I want the big facilities, 50,000 square feet or less. You should never invest in anything less than 50,000 square feet because, it costs so much money and blah, 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 and all this kind of stuff or whatever. And that's like this whole different, like the whole opposite side of us, like, $1 million or less. And these kinds of people or companies focus on like maybe $3 million or less. I would say maybe $2 to $3 million. Or more, not less, but $2 to $3 million or more. And so you have like these kind of two, like kind of bigger players. You have like the ones that the mom and pops that want to get in there, buy facilities, own smaller facilities. And then you have the bigger players that are like, I only want to be in like primary markets and focus on like, the top areas to be in and this kind of stuff. And then you have this like middle area, right? You have this middle area, which is about maybe $1 to $3 million properties, typically in secondary markets, I would say. And, but some tertiary markets, but mostly secondary markets. And you have in that little area, you have, which I personally call the sweet spot. I have in this area, you have the income producing properties, and then you have mismanaged facilities, and you can also build and do a bunch of stuff, but essentially you have mismanaged facilities and income producing properties. Okay, and so within this little area, if you found an income producing property that was a $2 million property, which I just talked to a coaching student that had a 1.8 $2 million facility, was income producing, and he could take that money and he could go to SBA and get a loan and just put a down payment, or you can go to a local bank and get a loan. Income producing properties are very easy to get funded if they're good deals. If you're at the right number, then they're easy to get funded, right? But in the industry, there is this sweet spot of like $1 to $3 million properties that are mismanaged facilities. A mismanaged facility, to me, and you guys can put in the chat what you think of mismanaged facilities if you know what they are, but a mismanaged facility to me is a facility that you cannot go to a bank and get a loan for, right? And that means that the property was not properly managed. It does not have a P&L. It does not have a balance sheet. It does not have rent roll. It does not have tax returns, or it's like 25% full, or 50% full, or 75% full. All right. And so those to me are what's called income producing properties. and I'm sorry, mismanaged properties. So those are this like $1 to $3 million that I come across these, or Chris comes across these quite often in the industry. They come across these in the industry, and these facilities are very, very hard to fund because there's no bank that's going to fund them, right?